there was about a 10-minute period where gold dropped like $300. I forget exactly how much, but it was a huge drop and an even bigger drop in silver. So both gold and silver closed.
The precious metals markets experienced unprecedented volatility last week, with gold and silver suffering dramatic declines that wiped out billions in paper value within an extraordinarily compressed time frame. Silver, which had reached an all-time high above $121 on Thursday, plummeted nearly 36% from its peak, trading as low as $77 before recovering to around $86. Gold similarly crashed from above $5,550 to below $4,900, erasing roughly $500 to $600 in value during the same period. These declines represent the largest dollar value drops in precious metals history when measured in absolute terms, though percentage-wise, similar corrections have occurred before, just never this rapidly. The Thursday collapse featured approximately 10 minutes. Gold dropped roughly $300, with silver experiencing an even steeper percentage decline. Friday's trading session brought additional carnage, pushing both metals to their weekly lows. Despite these spectacular drops, perspective remains crucial. Silver at $86 would have represented an all-time record high just weeks earlier. Gold, near $4,800, remains approximately 20% higher than levels seen just 1 month prior. January 2025 still recorded as the best month ever for gold performance, despite the $500 single-day loss on the final trading day. Silver's $30 single-day decline equals the metal's entire price from recent years, highlighting how far the bull market has progressed, even after this correction. The physical market dynamics contrast sharply with paper market action. Major online precious metals dealers are charging premiums $3 to $4 per ounce higher than more competitive pricing available elsewhere. 1 ounce silver rounds are trading with approximately 10% premiums above spot, higher than typical spreads, while gold maple leaves are priced around $5,000 with spot near $4,830. These elevated premiums during a price crash indicate strong physical demand despite futures market selling. The mechanics of Thursday's collapse suggest coordinated intervention rather than organic selling. Any rational seller attempting to exit large positions would gradually unwind holdings to minimize price impact and maximize proceeds. Instead, massive sell orders hit futures markets simultaneously, deliberately driving prices sharply lower. This pattern indicates the primary objective wasn't obtaining favorable sale prices, but rather moving markets downward through overwhelming selling pressure. The Trump administration likely orchestrated this intervention after recognizing that surging gold and silver prices posed systemic risks. The dollar had fallen to 4-year lows against major currencies and all-time lows against the Swiss franc. Bond markets were beginning to roll over. Gold's parabolic rise threatened to spill into foreign exchange markets and treasury markets in potentially destabilizing ways. Something needed to interrupt this momentum before broader contagion developed. The Friday announcement of Kevin Warsh as the new Federal Reserve Chair nominee provided the second element of this coordinated strategy. Media coverage portrayed Warsh as an unexpected choice, an inflation hawk who opposed quantitative easing and advocated for higher interest rates during his previous FOMC tenure around 2008. This narrative positioned him as more hawkish than Jerome Powell, potentially advocating for rate increases and renewed quantitative tightening rather than the rate cuts markets had anticipated. This characterization contradicts Trump's consistent messaging throughout his presidency. Trump has relentlessly criticized Powell for insufficient rate cuts, not excessive easing. His entire policy framework depends on lower rates to inflate asset bubbles, particularly in housing, where he explicitly stated his #1 priority is preventing price declines while ideally seeing continued appreciation. This requires dramatically lower borrowing costs, not higher rates from an inflation-fighting hawk. The Warsh selection represents misdirection designed to calm precious metals markets without actually changing policy direction. Trump wouldn't appoint someone genuinely committed to tight money and rate increases, as that would undermine his entire economic agenda. The positioning serves to provide cover for future rate cuts, allowing markets to interpret accommodation as economically necessary rather than politically motivated when an apparent hawk implements easing. Recent inflation data supports this interpretation. Producer price index numbers came in substantially hotter than expected, suggesting genuine inflation hawks would advocate immediate rate hikes. Yet Trump's existing Federal Reserve appointees dissented last week by voting for rate cuts, while others voted to hold steady. Warsh will likely follow similar patterns despite the hawkish marketing, implementing the easy money policies Trump demands, while maintaining plausible deniability through his supposed independence. The stock market's muted reaction confirms this analysis. Equity valuations depend entirely on continued easy money and rate cuts. If Warsh genuinely represented an unexpected hawkish shift toward tight money, stock markets would be crashing alongside precious metals. Trump's failure to crash equities while specifically targeting gold and silver reveals which alarm concerned him most: the monetary canary signaling dollar distress rather than broader asset bubbles. Central bank gold accumulation will likely continue despite this intervention. Foreign governments, particularly China, face negative real returns on dollar holdings, earning 4% nominal yields, while currency purchasing power declines 8 to 10% annually. China excels at mathematics and recognizes superior returns from domestic investment or Belt and Road initiatives compared to holding depreciating dollars. They conduct increasing trade outside dollar systems, accepting rubles or other currencies, but quickly converting proceeds to gold rather than accumulating alternative fiat currencies. This pattern persists until two fundamental changes occur. First, the United States must stop weaponizing the dollar through SWIFT and allow it to function as genuine global property rather than a political enforcement mechanism. Second, dollar-denominated assets must offer positive real returns instead of guaranteed purchasing power destruction. Neither condition appears remotely likely in the near term. Oil and gas represent compelling long-term investment opportunities given current dynamics. The global oil industry requires approximately $60 per barrel to break even when including capital costs, taxes, and royalties. With prices trading around 52, producers sell every barrel at a loss, 102 million times daily. This creates slow-motion liquidation, with industry-wide underinvestment in sustaining capital reaching $1 to $2 billion per day. Capital-intensive businesses cannot indefinitely defer investment without production consequences. Effects may not manifest immediately in 2026 or 2027 due to substantial stored capital available for cannibalization. However, by 2028 to 2029, chronic underinvestment will severely impact production capacity. Pemex provides a cautionary example, with output declining 85% over 30 years due to capital starvation rather than resource depletion. PDVSA in Venezuela similarly operates at just 15% of former capacity after decades of underinvestment. Recent headlines about Venezuelan oil returning to markets following regime change miss critical realities. Even with political transformation, Venezuela requires approximately $100 billion in capital investment to restore production from 800,000 barrels daily to 3.5 million. Infrastructure hasn't been upgraded in 22 years. The fiscal code remains punitive. Major international oil companies like Exxon, which has been nationalized twice in Venezuela, won't return without fundamental systemic changes. Even after reforms occur, intelligently deploying $100 billion requires years of careful execution before meaningful production increases materialize. Similar dynamics exist in Iran, where potential political liberalization might eventually enable rational oil sector management. However, Iran faces $40 billion in deferred sustaining capital, loss of high-quality technical personnel who departed for better Middle East opportunities, and replacement by Revolutionary Guard political appointees lacking technical expertise. These turnaround stories require far longer timeframes than headline-driven traders anticipate, creating extended periods where demand grows while supply remains constrained. Political risk assessments often reflect bias rather than reality. Experience across jurisdictions considered risky, including Congo, Sudan, and Syria, frequently proved more favorable than treatment received in supposedly stable environments like California or British Columbia. Canada imposed excess profits taxes, vacant home taxes, and speculation taxes despite general antipathy toward taxation. British Columbia's regulatory hostility toward mineral exploration meant the only politically safe territories were those where First Nations groups like the Tahltan or Nisga'a provided protection, a remarkable reversal where indigenous territories offered more reliable property rights than government-controlled areas. Alberta once doubled natural gas taxes when prices tripled, effectively nationalizing a portion of investor wealth. This represents identical economic outcomes to nationalization in developing countries, just executed in English according to rule of law, because expropriation followed legal processes conducted by establishment legislatures. It wasn't perceived as true confiscation despite identical wealth transfers. Western investors assign risk premiums to countries they cannot pronounce, while ignoring comparable domestic policy risks, preferring to believe Nicaragua presents dangers rather than examining their own governmental actions. Mining sector valuations remain compelling despite higher metal prices. Many companies still use conservative assumptions, $3,000 to $3,500 gold for pre-feasibility studies, even with gold trading near $5,000. Banks similarly underestimate future cash flows using outdated price assumptions. Wall Street and Bay Street analysts base earnings estimates on $3,200 to $3,300 gold, meaning actual results will dramatically exceed expectations if current prices persist. This represents material underestimation of future cash flows rather than minor forecasting errors. Major producers like Agnico Eagle show lower price to net present value ratios now than when share prices were half current levels, assuming metal prices hold. Market capitalizations haven't kept pace with underlying asset value increases driven by higher commodity prices. If current metal prices persist, many mining stocks remain substantially undervalued relative to intrinsic worth. One silver producer indicated that even with silver retreating to $50, profitability would remain strong and strategy unchanged, revealing how dramatically economics have improved for precious metals miners. The short-term trading action involved sophisticated manipulation. Several mining stocks declined Thursday morning, even while silver traded above $121 and gold made new highs. This suggests entities planning the futures market dump, pre-positioned by shorting mining equities with insider knowledge of impending price crashes. They accepted poor prices on future sales because they had already established profitable short positions in mining stocks ahead of the coordinated selling campaign. These shorts remain outstanding and must eventually be covered. The entities that sold massive quantities of gold and silver they neither owned nor could deliver must ultimately repurchase those contracts. Physical market buyers who are accumulating at $90 to $110 silver and $5,000 to $5,500 gold won't stop buying at $86 and $4,800. They'll increase purchases. Real demand from Asia, particularly China, which has driven the entire bull market, won't evaporate due to paper market manipulation during Western trading hours. Premium increases during price declines signal this physical market strength. Even as futures prices crashed, physical product premiums expanded rather than contracted, indicating robust real-world demand. These premiums will likely continue rising even if futures prices decline further, potentially creating situations where physical market prices increase while paper markets fall, a divergence that would expose the unsustainability of current short positions. Bitcoin continues underperforming despite promoter promises. Michael Saylor has spent approximately $54 billion purchasing Bitcoin over more than 5 years, establishing an average cost basis just over $76,000. With Bitcoin currently trading around $77,000, his total gain after 5+ years of aggressive accumulation equals roughly 2.5%. Treasury bills would have provided superior returns to the greatest investment ever, though Saylor couldn't have raised capital by promising Treasury bill purchases rather than Bitcoin accumulation. MicroStrategy's stock appreciation stems from excitement around Bitcoin accumulation and the premium at which shares traded relative to Bitcoin holdings, allowing leverage to acquire more Bitcoin. The company now possesses substantially more Bitcoin, increasing enterprise value. However, the Bitcoin itself generated essentially zero returns over the accumulation period. Any alternative investment would have produced better results, undermining the entire thesis that drove capital raising and share price appreciation. Ethereum experienced similar disappointment, approaching 5,000 before collapsing to 2,285. The promised rotation from gold and silver into cryptocurrencies never materialized. Bitcoin failed to rally when precious metals surged, but declined when gold and silver crashed. Every promise from Bitcoin promoters proved false. Money didn't flow from gold into Bitcoin during the precious metals rally, nor did it rotate into Bitcoin during the precious metals correction. Retail investors who purchased cryptocurrency in recent years, when most capital entered the space, have seen minimal or negative returns while watching other assets appreciate substantially. Leveraged cryptocurrency positions face liquidation risks as prices decline. Many holders borrowed against Bitcoin rather than selling, expecting continued appreciation. Now those positions will be liquidated at much lower prices to protect lenders, accelerating downward pressure. Bitcoin ETF outflows will intensify as retail investors recognize losses and exit positions. The massive single-day declines in precious metals, as dramatic as they were, will pale compared to Bitcoin's eventual reckoning when similar coordinated selling or mass liquidation occurs. The opportunity exists to exit cryptocurrency positions during this precious metals correction, rotating from Bitcoin at $77,000 into silver at $86, effectively exchanging an asset 40% below recent peaks for one roughly 30% below its high, but with fundamentally superior long-term prospects. The metals will recover and make new highs, while cryptocurrency faces structural challenges and eventual much steeper declines as leveraged positions unwind and retail investors capitulate. Housing market commentary reveals policy priorities. Trump explicitly stated his #1 goal is preventing housing price declines, in fact, desiring continued appreciation despite current affordability crises. The free market solution involves price declines until homes become affordable at levels people can actually pay. Trump rejects this, instead seeking ultra-low interest rates enabling continued borrowing to sustain unaffordable prices, requiring massive monetary inflation rather than market clearing. Appointing a genuine inflation hawk would contradict this entire framework, confirming that Warsh's hawkish positioning represents misdirection rather than actual policy direction. The mining stocks present exceptional value, given coming earnings surprises. Recent selling created opportunities to accumulate quality producers at depressed valuations, despite gold and silver prices remaining substantially above levels used for analyst estimates and company guidance. These equities will report phenomenal earnings based on much higher realized metal prices than forecasted, driving upward revaluations once results are published and markets recognize the magnitude of underestimation. Current volatility shouldn't deter accumulation, it should accelerate it. Paper losses mean nothing for long-term holders with no intention of selling. The money lost during Friday's decline didn't exist weeks earlier. Easy come, easy go. Confidence in much higher future prices remains unchanged. Short-term price action provides opportunities to accumulate physical metal and mining shares at temporarily depressed levels before the next upward leg begins. Physical product availability deserves emphasis. Online purchasing avoids phone delays during high-volume periods. Whatever products remain in stock should be purchased without excessive selectivity. All offerings provide good value at current pricing. Premium expansion indicates tightening physical supply, even as paper prices decline, suggesting availability windows may narrow if demand continues while dealer inventories deplete. The coordinated intervention succeeded in temporarily interrupting precious metals momentum and calming dollar concerns. However, fundamental drivers remain intact and intensifying. Massive fiscal deficits, negative real interest rates, dollar weaponization, and central bank diversification haven't changed. The alarm was temporarily silenced, not eliminated. Prices will resume their advance, likely more rapidly than short sellers anticipate, potentially trapping them in positions they cannot cover without driving markets to new highs. This correction represents opportunity rather than invalidation of the bull market thesis.